Coming up today, stocks snap their 4-week losing streak. Recession fears grow. Do we have more pain ahead? The latest from Nike. Tesla having its worst stretch ever. The latest robot news. How to invest in SpaceX. And what's a collateralized burrito obligation. You're really going to enjoy this one, guys. Let's go. And welcome back, everybody, to the Click Capital Daily Market Review. Thanks very much for tuning in with me here today. I've got a really good one for you. We're going to be covering some interesting stuff on this triple witching day in the markets. Almost $5 trillion in options expired today. It was rather uneventful price action. Pretty soft across the board, but once again, mega cap tech doing its own thing here, especially Tesla. We may have just got the waltz bottom. I've got some interesting stuff as usual to share on that later on, along with recent developments coming out from the company. And so even though all the main indices finished slightly lower today, we pretty much grinded sideways all week here. Eked out a slight gain on the SP, Qs, and Russell. It was actually the Magnificent Seven, putting in a pretty constructive candle here today, gapping down below yesterday's low and finishing at the highs. Bit of a bullish engulfing candle there on building volume. And just looking at my DSI, we've got a building bullish divergence here. But we'll come back to the main indices later on in this video, and I'll show you all my custom indicators and what they're telling us, along with my opinion on what the chances are we've already seen a bottom in this correction. With the last week of Q1 next week, and reciprocal tariffs officially set to kick off on the 2nd of April, along with PCE inflation. Next Friday as well, we could be about to see some huge moves in the markets. Going into the last week of Q1 here, but stick with me today and I'll show you guys again this new ETF, the Entrepreneur Shares Private Public Crossover ETF that I recently invested in, with its largest position actually in SpaceX. It managed to secure some shares. And so I'll show you what other private company this ETF actually holds, as we just had some fresh news out from this company today. So later on, I'll show you all of this ETF's holdings and why I'm excited about investing in it. I think they've got a great strategy, and I'll also share with you guys some funny memes as well for some lighthearted humor going into the weekend here. And if at any time during this video you appreciate this type of content, then think about clicking on that subscribe and like button to help support this channel. And so these videos show up in your feed every day, so I can help you stay on top of markets. And just to give you the bird's eye view of where we currently sit, seems like we're stuck in the extreme fear zone here. 23, been here for weeks now. Market traded sideways this week, still trying to find its feet, with a lot of people obviously still on edge. Seen investor sentiment surveys persistently bearish for over a month now, getting some real record readings, typically associated with bear markets and financial crises. Investors have never been more worried, with the stock market not that far from all-time highs. Really is a unique setup I've got going on here. But it's not a global stock market sell-off, pretty much been confined to the States. We've seen record rotation from fund managers, selling US equities and buying international equities. In fact, we're getting similar readings, prior lows in the US stock market. But seasonally speaking, looking at price action and fund flow, we're coming into a pretty good period going into April. Typically see a lot of funds buy into the market, and especially now with stocks having come off a lot in the last month and a half. In addition to bond yields coming down, like I said, next week we could see some huge rebalancing and volume going into the end of Q1. Also, pivotal date will be the 2nd of April, where reciprocal tariffs are officially set to kick off. We've seen the European Union push back their retaliatory tariffs a couple of weeks, as they may be getting a little cold feet, trying to escalate a trade war against the largest economy in the world at a time they're still struggling with growth. And it's kind of interesting looking at the price action in the market, because if we are going to go into a full-on nasty global trade war this year, still possible for sure. I think it eventually will resolve itself to the upside. However, it very well could get worse before it gets better. And if that were the case, trade policy risk favors smaller stocks. In fact, looking at mega cap tech, they get about half of all their sales outside the States. But you remove them from the S&P, it's only a bit over a quarter of large cap companies. Sales are from outside the States, and even lower for the Russell 2000, 21%. And that's what I mean, it's interesting because this whole sell-off has been on the narrative of a global trade war. They're set to knock over economic growth, and the Russell 2000, the least amount exposed to that, still down almost 17% from highs here. But this to me does look like the market in the process of building a bottom. And like a lot of bottoms and tops, it's not just a clean 1, 2, 3 pattern. It can be a little messy. Price can grind for a few weeks. But more on this later. It's not only the price action in smaller stocks, also valuation. Looking at the forward price to earnings ratio, what companies are expected to make in the next 12 months, and earnings per share divided by their share price. We've actually come down quite a bit in the Mag 7, now at 25, which I think is really reasonable given they're really high quality, monopolistic businesses to begin with many of them still growing in healthy double digits. But removing them and just looking at the average company in the S&P, which is large caps, I think it's hard to make the argument that we're in a raging bubble here when they trade at 19 times earnings. Remember, we're in a 4% interest rate environment. All valuations are relative, and those rates could be coming down over the coming months as well. And this is now approaching the mid-range over the last decade. And these companies have really caught up to the Mag 7 in terms of EPS growth this last year as well, and forecast to keep closing that gap this year. And by far and large, earnings are holding up as we make our way to the end of Q1. Earnings season always kicks off about 3-4 weeks into the new quarter. So by the end of April, we'll start hearing Q1 numbers and forward guidance from key companies that'll help play into the market as well. Analysts are expecting 11% growth in earnings for the S&P this year, and about 7.1% for Q1. Typically, the first half of the year can have softer growth than the second half. Consumers typically do most of their spending in Q3, Q4, and hence why we can get good numbers at that time of year. But these are really good numbers, even for next year. Analysts are expecting 14.2% in earnings growth. And if rates were to come down to around 3.5%, in my opinion, there's no problem in paying 25 times earnings for that type of growth relative to rates. And so this correction we've had in the market hasn't been on earnings or expectations falling off a cliff. It's actually just been a contraction in multiple. Because as of today, earnings per share and forward earnings per share expectations for the key tech sector are at all-time highs. Anyone short the market or out of the market, which is basically the same thing, you're trying to time the market, you are short this line here. And JP Morgan, like myself, believes Nvidia is now good value. They just came out yesterday with a fresh price target on Nvidia, $170 a share, highlighting that the key drivers of their business are still in full swing. Data center spending shows no signs of slowing down. But just don't tell that to plenty of people out there, especially the fearmongers in the media, just continually getting a barrage of negative, pessimistic headlines. Recession alarms are ringing on Wall Street. Here are 4 warnings economists are pointing to. The first one, household finances are deteriorating, going on to show a chart of household debt now sitting at all-time highs. However, just looking at absolute numbers is kind of ridiculous. As economists should know, there's a little thing called inflation, and hence why we should always measure things relatively, not in a vacuum. Because looking at household debt service payments as a percent of disposable personal income, we're down near the low end of the range over the last 50 years, and well below those peaks going into the GFC when consumers were levered to the gills. And in fact, looking at United States households' debt to GDP, we're currently at the lowest reading we've seen over the last decade. So yes, in absolute term, consumer debt, credit card debt is at all-time highs. But just like many of us personally, our dollar debt could be at all-time highs. However, as a percent of our asset or repayments as a percent of our income, they may as well be near lows. So be careful of anybody who presents to you absolute stats, because they're kind of useless in my opinion. But they do make for good fodder and headlines. Some other reasons they gave for why we could be on the cusp of a recession is small and mid-cap stocks are doing poorly just because they've had a sharp correction so far this year. I think that's more of a reason to buy. More companies are warning of weaker earnings, they said. Well, yes, looking at some key retailers who are exposed to tariffs and really want to try and talk them away. No doubt there's a little truth there. The bond market's pricing in more risks, which I would disagree with. Treasury bond yields have not fallen off a cliff like they did in Q3 last year, when everyone was sounding the recession alarm bells. And looking at corporate bond spreads, although they've ticked up a little bit the last couple of weeks, they're still relatively really low. Another one, Nvidia stock just flashed a dreaded technical death cross signal. That's when the 50-day goes below its 200-day. However, if you actually backtest that on the indices, and even more so on a high-quality stock like Nvidia, that trading system, going short a stock or index when the 50-day goes below the 200-day and then exiting once it goes back above, loses money over the long term. In other words, on a quality stock or index, it's more of a buy signal than a statistically valid sell signal. Another one, president was supposed to boost M&A. So much for that. Apparently he hasn't got deal making on fire within 2 months on the job. He promised us growth. Tariffs are delivering pain instead. I still think the economy and the markets by extension are in pretty good hands here, even though for sure we're going through some initial recalibration in markets, which is not all that unusual looking back in history, with a new admin, year 3 of a bull market, Q1 of a new presidential cycle. But like I said, it's not just the media, it's also big banks, institutions, the Federal Reserve. Everyone is very skeptical of the new admin's strategy here and is kind of treating it as guilty until proven innocent. Shoot first, ask questions later, as the market can often do. And even iconic American consumer brand Nike is calling out tariffs as maybe a bit of an excuse for what, in my opinion, is a brand in decline. After we just got their earnings, they gave a soft outlook. Market sold them off a bit here today, down 5%. But like I said, companies that do rely on China and Mexico to make all their goods like Nike are for sure exposed here. They deserve to be discounted by the market. But just going out to a weekly chart on Nike here, they had problems long before this new admin. In fact, like many companies that adopted woke policies in 2020 and 2021, they peaked out and they've come off hard ever since, and they didn't bottom out and rally like the rest of the market did in late 2022. We've seen that with Disney, we've seen it with Target, and especially so with Nike. Speaking personally myself, I also swore off the brand back in 2021 due to them driving political ideologies that I strongly disagree with. I used to always buy Nike shoes, probably one pair a year. I haven't bought a single Nike product since, and I don't plan on ever again either. I'd much rather buy local products and something with decent material as well, not made in a sweatshop in China or Mexico. But anyway, that's the path they chose, and now tariffs are just kind of adding even more pressure to their valuation here. I think it's lost its shine that it enjoyed for many decades, and it's not really the strong brand that it once used to be. So I think this could turn into one of those kind of sleepy elephant stocks that just trades sideways for the next 20 years, as they've probably already had their day in the sun. But it's not all bad news with this business-driven administration. Just looking at some of the good things coming about and having to go to X for that, as we don't hear too much about it in the mainstream media. The United Arab Emirates just agreed to invest $1.4 trillion in the States, targeting AI, energy, and healthcare. Deal after deal, trillions of dollars pouring into the States. I just can't see how that's a bad thing. Countries around the world are all competing with each other for international capital. Everything starts with capital investment, because from that, it creates new jobs, it creates innovation, new technology, and the country that can attract the most capital enjoys premium valuations, the lowest bond yields. Healthy capital markets make it more easier to raise and distribute capital. And in my mind, this is absolutely breaking out on the upside for the state. In terms of some of the biggest investors in the world, sovereign wealth funds and the such, even though for sure we're getting plenty of institutional investors sell US stocks here, that's just hitting the tape on the screen. Looking in at the actual economy, there's trillions flowing in addition to the government getting smaller and smaller. In fact, we just heard 600 workers at the Securities and Exchange Commission take some buyout offers, and that in my mind is very bullish for the stock market when its regulator is getting significantly shrunk in tandem with a culture change and how they approach market, looking to really free things up and accelerate the state's lead. And the new gold card program, which I reported on a few weeks ago. I remember someone said to me in the comments, I doubt they'll even sell 2,000 cards all up, which I replied to them, they'll probably just sell that in Dubai alone, given there's almost 80,000 millionaires there. We just heard from Commerce Secretary Howard Lutnick. They sold 1,000 gold card visas worth $5 million each in a single day. That's $5 billion in revenue from just one day. Not only improves the government's balance sheet, American taxpayers, debt owing, the more they can do this, the less government bonds they'll have to issue. Plus, think about all that halo effects from all these really wealthy and talented people coming to the States, even if it is just so they can open a business there, spend part of their year there, have another holiday home or whatever. Once again, it's just bringing an influx of capital into the States, as no other country attracts more talent from around the world than the States. Another reason that makes it exceptional, but more importantly, the one thing the States have that no other country around the world has is currency reserve status, the US dollar, which gives huge advantages, allowing the Fed to pretty much print at will without it devaluing the currency, at least not in the short term anyway, giving us investors a good put option to lean back on. Remember, we'll always have the White House put as well. Things get bad enough in the markets and the economy, and the new president will meet his trading partners somewhere in the middle and dial them back only if he has to, but for now, he's playing hardball and trying to get them to meet him in the middle and lower their tariffs on US goods. And the man that helped him get into power, potentially tilting the election, forever changing history, has been paying a huge price for it, with Tesla stock having its worst stretch ever, along with his reputation being dragged through the mud, and media outlets piling on as well, even the Journal today, profiling Tesla investors that have given up, as we continue to see a spate of attacks, not only across the States, but around the world as well, on Tesla vehicles, dealerships, recharging stations, calls for boycotts, arsonist attacks, the list goes on, for which they're already catching some of the culprits. Apparently these three men, I think, have been charged with Tesla vandalism and arson attacks, facing long sentences. But they shouldn't serve at home. I really like this idea here. Charge them under domestic terrorism laws, and you can ship them off to El Salvador, where they can make themselves at home in a nice little cell over there, also helping to clean out the country of its worst. But this attack on Tesla isn't just occurring at the street level, it's also occurring at the highest level of politics as well, with the would-be vice president this week coming out and saying he's enjoying watching Tesla's stock price go down and down, last quoting it at 225, Also encouraging Tesla owners to deface their vehicles and take off the logos. Keep in mind this is the most American-made car, and then his own state's pension fund has about 4% exposure to Tesla. So no doubt this is an issue in the short term, at least for Tesla. Brand damage, I think the people coming out in support of it will exceed those trying to attack it. But Musk did just come out last night and tell his employees to hang on to their stock. And I've recalled him doing this several times over the years in previous bouts of big sell-offs that we've seen. Previously, when hedge fund managers really came after the stock between 2017 and 2019. It was under attack back then as well, for which they all lost a lot of money. But he did come out with a good presentation to try and reassure his partners and supporters. Did reiterate the Model Y still on track to be the best-selling car in the world this year for the third year in a row. And the whole narrative that they're just an EV company, I think, is pretty much dead. The huge growth we've seen in energy storage quarter after quarter, already making almost $1 billion in gross profit just last quarter, just in that category alone. Yet alone FSD, which we're on the cusp of taking off around the world. Other automakers could very well license that technology like they've done with their recharging stations. The potential of robotaxi is just mind-blowing, so is Optimus. As he reiterated, they will go into production this year to start working at Tesla factories and other businesses around the world next year, then consumers after that. They're looking to make about 5,000 Optimus bots this year. And it's not just Tesla. We're getting more and more positive developments in robotics. We also heard from Figure Robot, which is making leaps and bounds with their humanoids, almost ready to start work in factories. And we just saw 1X humanoids present Jensen Huang his own leather jacket at the Nvidia AI conference, as he looked really impressed with, as these things are starting to come to life and his chips are no doubt going to power them for many more years to come. And there's a look at Nvidia daily stock price, kind of just been a muted reaction this week on their conference, similar to the market, just calling up here sideways and low volume, potentially getting ready for a big move next week. And looking pretty good there today on Tesla, up over 5% in a soft tape on really good volume here. Got a building and sharp bullish divergence. And like I said, we may have just got the waltz bottom, and he may have just jinxed me from being able to reload again at 188. Like I said yesterday, we may have already seen the low in Tesla at 217 a week and a half ago. Because not only are we shaping up here on the daily chart, just going out to the weekly chart, just done 9 consecutive down weeks after we peaked out at almost $500 a share. And this is starting to look like a potential reversal pattern in the market here, a bit of a weekly inside bar on a second consecutive hammer formation, in addition to my reversal signal here, which is pretty rare on the weekly chart. In fact, just going back in history, the last time we got it was in November 22, which was a bit before the low there, but still not a bad point by the dip in a long-term position. Going back before that, it was quite a while. It was actually back in June 2019 when it actually nailed the low back then, when the stock was around $12, split adjusted per share. Prior to that, it also nailed the low back in 2016. It was a reversal signal. And before that, there were none bullish reversal signals. So this is one of my most accurate indicators. And it has been one of the sharpest sell-offs we've seen in years for Tesla here. And going back to the daily chart, we do have some really good bullish seasonality, especially over the next 2 and 3 months. Can often be a good time of the year for the stock here. And so like I said, Tim Waltz may have done it for us bulls. We'll just have to wait and see. And that could be an iconic bottom that we talk about for years to come. But just moving on to the ETF that I profiled yesterday, the Entrepreneur Shares Private Public Crossover. With its largest position in SpaceX, I'll show you what other private company they hold and all their holdings. But first, just a bit of a recap. It's an actively managed fund that invests in entrepreneurial, innovation-driven companies. The core of its strategy is a proprietary entrepreneur factor, which is kind of really interesting to me. I've long studied other investment factors like value, momentum, quality, size, volatility. But they've really worked on a new one, entrepreneur factor. Quite often, these founder-led companies outperform. But it isn't just founder-led companies. They also look at quality of the management, visionary leadership, the level of innovation, R&D, management turnover, market presence, financial discipline. And so they pretty much come up with a score for every stock out there. And then only companies in the top 25% of their entrepreneur factor score are eligible for inclusion. So it's quite an actively traded fund. They do have high turnover, quarterly rebalancing, currently got 32 holdings. And just looking at the fund profile here on the Entrepreneur Shares website, another thing I like about this fund is they target secular trends: space, artificial intelligence, robotics, genetic engineering, medtech, fintech, cloud, 5G, 3D printing, nanotech, renewable energy, and so on. In addition to having a bit of a macro overlay, ensuring companies align with broader economic and technological shifts, placing strong emphasis on sustainability and social impact. But a unique feature of this ETF is its ability to invest up to 15% of its assets in private crossover stage companies, those that are on the verge of going public, giving early exposure to potential disruptors before IPO when the valuation increases. So this hybrid approach blends private and public companies into one investable vehicle with public market liquidity. And so we can see here on their website all their holdings, and there's SpaceX right at the top, almost 11%. We've got Alphabet, Meta, Nvidia, Oracle, and many other what I'd call global digital platforms, which I think are the most quality, exceptional businesses in the world, the most scalable. And those really kind of dominating in their industries of the digital economy. And so regardless of their SpaceX holding, I really like this strategy. I like their holdings. I like their approach. I like the sectors they're focusing on. They can invest in companies as low as $2.5 billion market cap. In addition to SpaceX, they also have a small position in Klarna. And so Klarna is a real up-and-coming company. I'm sure many of you have heard about it. Buy now, pay later, which is really starting to grow mainstream, this brand around the world as well. Dedicated shopping app and another avenue for revenue generation, businesses as well. And so we just got big news yesterday that Klarna and DoorDash, competitor to Uber Eats, have partnered up with DoorDash, allowing their customers to use Klarna's buy now, pay later payment options in the delivery app. No doubt a great move for both companies. And from that, we're getting some legendary memes. Just a bit of lighthearted humor here for you guys going into the weekend. Picture of Ken Griffin, founder of large hedge fund Citadel. You're telling me these loans are backed by consumers who ordered burritos on DoorDash, alluding to financing Klarna and looking at what that debt is backed by. Here's another one. Donnie from the Wolf of Wall Street movie. You financed a $12.78 steak bowl from Chipotle? And Jared in The Big Short, during his presentation to Mark Baum, collateralized burrito obligations, and Michael Burry from the same movie. They're called chimichanga default swaps. Classic stuff, right? You can now borrow to buy a burrito. God bless capitalism. But anyway, like I said, really like the strategy of this ETF. The fact that I can get exposure to SpaceX, as small and indirect as it is, that's still my best option. And its underlying strategy of investing in entrepreneurial-driven, innovative companies sits really well with me. Not like a lot of ETFs that own 100 or 200 stocks. It holds 32, which I would say is the perfect amount of diversification and concentration for an actively managed fund. And so I plan on staying invested in this at least until I can invest directly in SpaceX when it IPOs on the market. And that very well could still be a couple of years away, by which time it may even be closer to $1 trillion valuation from its current $350 billion valuation. And even beyond that, if the strategy's been performing well and I'm still happy with it, I could even keep it as a core holding, as I really like what's in there already. And some people will say, oh, it's too tech heavy, like that's a bad thing. But in my mind, that's a positive attribute because technology is the number one wealth generating sector there is. Okay, let's wrapping it up here, guys. 2-year at 395. We've got core PCE, the Fed's preferred inflation gauge, coming next Friday. We also got GDP growth on Thursday. A little bit of economic data as we go into the end of Q1. In addition to, like I said, a potentially huge rebalancing in the market. Seasonal inflows set to come in. The yield differential between stocks and bonds sharply moved in favor of stocks this last month. And we are getting some bullish divergences here on the chart. But it wasn't really an eventful triple witching. Did see a bit of volume come in on the close as usual, but up until that point, it was a pretty light volume day. Most of the indices didn't even move 0.5% up or down. Volatility term structure actually finishing the week looking more normal in a state of contango, but not by much. Front month just underneath the second month here, still flirting with those dicey levels, but a pretty good recovery in high yield bonds after a sharp sell-off last week. Bitcoin still limping around, but could also be in the process of trying to form a low here. Been grinding sideways for a few weeks. And same with the Russell 2000. A few gap downs we've had this week seeming to get bought. The market's still trying to find its feet here. So I still think there's good odds. We've seen the low, but of course we shouldn't be surprised to see a retest even potentially early in the week. Typically Mondays this year have been really weak. Could very well get that gap down to start the week. And then the market will really be looking forward to GDP and PCE inflation to key off that. As we round out Q1, and then in a few weeks' time, we'll kick off Q1 earnings season. But that's pretty much a wrap for the daily market review this week, guys. Thanks very much for tuning in. And if you enjoy this type of content, please go ahead and click that like button and subscribe if you haven't already. And I'll do my best to keep you updated every day after market close with everything that's going on out there, along with my analysis and breakdown of it all. As always, it's just my opinion. You're welcome to share yours in the comments below this video. Otherwise, enjoy your weekend, and I'll see you guys again come Monday night. Cheers.